You've been watching silver completely wrong, because every single person who told you silver moves due to Fed policy or geopolitical tension is feeding you surface-level junk. They are giving you the clean, neat little narrative that fits perfectly into a news headline, and worse, you built your entire trading thesis around it. You watched silver climb to $75.6 an ounce last Friday, marking a third straight weekly gain up over 4% in 5 days. And you probably patted yourself on the back thinking you understood exactly why, crediting a weaker dollar, US-Iran talks in Islamabad, and rate cut expectations. That is the story every financial outlet spoon-fed you this week. And you swallowed it because it makes sense, but the problem is it always makes sense in hindsight. Because while you were refreshing your portfolio, watching the dollar index tick lower, and reading Twitter threads about Middle East negotiations, something far more massive was taking shape. This massive shift is happening on the exact opposite side of the planet, where China is quietly preparing to ban exports of sulfuric acid, possibly as early as next month. Now, I know exactly what you're thinking. Sulfuric acid? Seriously, man, boring. Next video. But hold on and stop right there. Because that instant reaction, that urge to click away because it sounds like high school chemistry, is the single clearest signal that the broader market has not priced this in yet. The market has not priced this in yet, not even close, as we're talking about a market that has seen demand outpace newly mined supply for 6 consecutive years. It is 6 years of physical tightness quietly compounding beneath a price chart that, until recently, barely reflected reality, as vault inventories have been draining and refiners working overtime. And right into the middle of that already strained system, you are about to inject a massive supply disruption that targets the very mechanism through which silver is produced. This isn't a geopolitical headline that fades in 48 hours, and it isn't a Fed rate expectation that shifts with the wind. This is a structural, physical fracture in the supply chain of the metal you think you understand, and that is the lie you've been building your portfolio on. You thought silver was just a macro trade, a rate cut play, a shiny safe haven you buy when the world gets scary and dump when things calm down. You've been treating the symptom and completely ignoring the anatomy because the real engine driving silver's price isn't sitting in a Federal Reserve press conference. It's sitting in an acid processing plant in Guangdong province, and it's about to go offline, where the geopolitics, the rate cuts, and the dollar weakness matter. But they are a sideshow compared to what happens when the physical supply of silver gets choked off at the source, in a market that was already bleeding inventory. So before you open TradingView and draw another triangle, ask yourself one question. Do you actually know where your silver comes from? Because if your answer involves the Fed or the dollar, you've been reading the wrong book, so let's do the math that nobody on financial television wants to do. Because once you see these numbers, you can't unsee them, so start at the end of the line and picture a massive solar panel factory in Germany. Picture an EV battery plant in Michigan or a semiconductor lab in South Korea, because every single one of them needs physical silver, not paper silver or futures contracts. They don't need ETF shares, they need actual physical metal delivered to a loading dock, weighed and plugged into a product. And here's the kicker, they cannot substitute it, because there is no alternative conductor that does what silver does at the efficiency their tech requires. So when supply shrinks, these guys don't just shrug and say, let's wait it out. They bid higher, they bid aggressively, and they bid against each other. They bid just to keep their assembly lines running, and that desperate bidding war is what turns a quiet supply deficit into a violent price explosion. Now rewind to the source and ask yourself, where does the supply actually come from? Because here's the stat that should keep you up tonight. 70%, roughly 70% of all newly mined silver on this planet does not come from silver mines. It comes out of the ground as a byproduct of copper mining. Let that sink in. The majority of the world's new silver supply is basically a happy accident, a secondary output of a totally different industrial process. Silver's fate is handcuffed to copper, and copper's fate just got handcuffed to sulfuric acid, and there is no plan B here. Sulfuric acid is made from elemental sulfur, and global sulfur supply is already getting squeezed because shipping route disruptions have choked off the raw feedstock. So when China cuts off acid exports, copper miners in places like Chile can't just snap their fingers and spin up domestic acid production. They can't overnight a massive shipment from somewhere else because there are no surplus warehouses sitting around waiting. And they definitely can't rebuild their entire billion-dollar extraction infrastructure to run without acid. So walk the chain forward with me. China bans acid exports, Chile loses a third of its processing capacity, and copper output from the world's top producer hits a brick wall. And because 70% of new silver rides on the back of that copper, silver output drops right off a cliff with it. This happens not because of a miner strike, and not because the Fed did something, but because a boring chemical input disappeared from the supply chain. Now take that reality and layer it on top of a market that was already starved. Going into 2026, we've had 5 straight years of structural deficits. 5 years of the world burning through more silver than it digs up. Industrial demand is skyrocketing, and investment demand is climbing because people are terrified of inflation, while old mines are tapped out and new mines take a decade to build. And recycling is basically a joke, because the silver in your iPhone is too thin to profitably extract. The math was already terrifying before anyone muttered the words sulfuric acid. So what happens when you compress supply into a market that is already short? You don't get a nice, gentle 2% upward drift, you get a violent repricing. That's why the move from $72 to $75.60 this week was just noise, driven by a weak dollar and a ceasefire taking the edge off geopolitics. But tailwinds fade, and what doesn't fade is a broken supply chain, because the math doesn't care about analyst coverage or CNBC talking points. Less acid means less copper, and less copper means less silver, which ultimately means higher prices. And the timeline for this isn't some abstract prediction for 2030, because it starts next month. The question isn't whether silver goes up, as the math already guarantees that. The question is whether you will survive the volatility long enough to actually profit from it. See, silver moves 2 to 3 times faster than gold in both directions, and Morgan Stanley actually put a number on it. A 5% move in gold can translate to a 15% swing in silver, which sounds incredibly exciting when the chart is green. But think about who that volatility is actually designed to kill. If you are a massive hedge fund with a risk management desk and complex options hedges, you harvest it. But if you're a guy on your laptop with a $5,000 account and 3-to-1 leverage, that volatility is a buzzsaw. One overnight gap down and your account gets vaporized while you're asleep, meaning your thesis could be 100% right, but you still got margin called in week 2. People love calling silver gold on steroids, but what they don't tell you is that the steroids eventually give you a heart attack. The volatility isn't a bug in the system, it is the business model used to shake weak hands out of the market. So how do you actually play this without blowing up? First, stop YOLOing your entire cash stack into a single entry on Monday morning, just because you heard silver is going to $100. You buy the top, it drops $3, you panic sell at a loss, and then you spend the next year leaving angry comments about how the market is rigged. The market isn't rigged, your entry strategy was just garbage, and if you want to trade this, look at the 100-ounce silver mini futures. It's small enough that you aren't committing a massive chunk of capital to one trade, so you layer in, buying a little this week and a little next month. Your average cost smooths out, and you stop caring if today's price is $73 or $77, because you're playing a 12 to 24 month horizon. If you have higher risk tolerance and understand options, you look at structures with defined risk, like a bull call spread for December 2026. You buy the $100 strike and sell the $110 strike against it, where max payout is huge if it hits. But more importantly, if silver stays flat or drops, your loss is capped at the premium you paid, so there are no 3 a.m. margin calls. You defined your risk before you even clicked buy, and yes, the premium decays, meaning time works against you, but that's the price of admission. You are paying for the right to be wrong without going bankrupt. But here is the most actionable, boring, and profitable advice I can give you tonight. Open a spreadsheet. I am dead serious, just 4 columns for date, amount deployed, execution price, and average cost. That is it. No fancy charts. This spreadsheet is your leash, the only thing keeping you from panic selling when silver drops 4% in a week and your lizard brain is screaming at you. Pick your instrument, pick your dollar amount, pick your schedule, and do it blindly because it doesn't require conviction. It requires a calendar reminder and the ability to embrace being completely bored, while retail traders are oscillating between euphoria and depression. Because here is the harsh truth to wrap this up. The market does not owe you a single dollar just because you figured out the sulfuric acid angle before your friends did. The market doesn't care that you are smart. It only cares if you're still standing when the thesis finally materializes. Because being right and surviving long enough to get paid for being right are 2 entirely different things. I am not here to guarantee silver hits $100, and I'm not here to promise you a Lambo. I am telling you that the structural math, the deficits, the acid ban, and the unstoppable industrial demand create a massive asymmetric setup. The downside is a temporary flush to the low $60, while the upside is a historic repricing that dwarfs anything we are seeing right now. But you have to have an exit plan, so decide right now, while you are calm and rational, where you will take profits and where you will cut your losses. Write it on a sticky note and put it on your monitor, because when the price starts ripping, and it will, your brain will invent reasons to ignore your own rules. I'll be right here next week, breaking down the fallout from the weekend talks, the Fed's next move, and whatever China decides to do with this acid ban. The headlines will change, but that underlying 6-year supply deficit isn't going anywhere. So do your own work. Verify the numbers I just gave you, stay sharp, manage your risk, and I'll see you in the next one.